aspects as well. That is the first thing which I am going to do. So you may be aware that there are 44 clauses in a revised 3CD form. Okay. So I'll be walking you through a clause, and I'll be explaining the provision which are relevant for understanding that particular clause. So that is the major agenda for today's session, followed by what are the common mistakes which every one of us are doing in our offices, because of which there are lots of litigation going on. Remember, you as a student, you as the article student, you as the paid staff, you as the paid staff, you will be spending most of the time in compiling the data. So your boss, your principal may be overviewing and overseeing the data and the various other information which you have compiled for reporting purposes. So that's why to understand what are the common mistakes. If you have done this type of mistake, what is happening? Mistake. See, it looks like a silly mistake, or it may look like a super silly mistake, but because of that silly mistake or because of that super silly mistake, what is happening? Replying to the same in your absence or in your presence, whatever. Reason is very simple. You compile the data. You may go on 6 important clauses in where you need to compare in ITR 6. Of course, in other ITRs also it will be there, but for reference purpose I have taken ITR 6. And at last I have given what are the recent amendments. Why it is required? Because each time when you are doing a tax audit, you should be keeping handy what are the amendments relating to that particular assessment year. For example, for the assessment year 2021, the amendments made by the Finance Act 2019, so they are relevant. So that is the reason why I have given at the end. So I'll summarize very quickly the amendments which are relevant for compiling the data for 3CD purposes. So now let us move on to section by section. The first section is Form 3C or 3CB and 3CD. Okay. See, as you all are aware that 3CA and 3CB, these are audit reports. 3CD is a compilation of the particulars. Right. So remember or understand the difference between 3C and 3CB. See, you cannot take them as granted, saying that, okay, sir, shall I fill up in 3C or shall I fill up in 3CB? Understand what is the difference between 3C and 3CB broadly. See, both are audit reports only, but what is the basic difference? You may be knowing, but let us understand it better, as simple as that. See, 3CA will be used where the books are already subjected to audit under our law. For example, you are doing tax audit for a company SSC. So you have to fill the 3CA because the books are already subjected to audit under some other law. That is the thing. On the other hand, if it is not done and you are doing the first time, for example, partnership form is there. Generally for partnership form, under the relevant act, there is no necessity to get books of account audited under any other law. But because of the Income Tax Act, they are liable to get books of account audited. So in those cases, you need to use the form 3CB. So that you need to remember. Then the critical question here is, there are some people who may be encountered with this issue. What is that issue? Sir, my client's accounting year is calendar year. So the calendar year, they are following the calendar year like January to December. So the statutory auditor has done the audit from January to December. In those cases, which form is to be used? Shall I use 3CA or shall I use 3CB? That is the question. See here, okay. Shall I use 3CA? 3CA when we have to use where it is liable for audit. But you cannot use 3CA in this case for the simple reason that the statutory auditor would have done audit only up to December. So far as January, February, March is concerned, they are not audited. That's why you have to use 3CB in those cases. So That is the point which you need to remember. Okay. Now let us move on to the 3CD. There are 44 clauses. Okay. Now the part A, clause 1 to 8A. So they talk about the part A. Part B, clause 9 onwards till 44. Right. Part A, it contains the basic details. Yes, it is a basic detail, but at the same time, you should not do a mistake in compiling the data and reporting this data. Name of the assessee. So you collect as per the PAN number, you take the backup document like certificate of incorporation. So what is the name given there? That you have to report it here. Why it is important? Let me explain. Name is important, address is also important. Why it is important? For the simple reason that you typed name wrongly here, and in the assessment order the name has been given something else. For example, okay, ABC India Private Limited, but you have typed it here as ABC India Limited. Their actual name is India Private Limited, something like that. Then when you are going for appeal because of any, prove that both are the same persons, bring me an affidavit. So in appeal, what happens is the higher authorities, the judicial authorities will question why this type of mistake is there. You cannot say that, sir, my article student. We cannot say that my article student has done. Ultimately, it is our responsibility. So when you are doing, so you check the backup document, based on that you fill up. Right. Address. So why address is important? Whatever address I want, I will type. Who will see? No one is going to see. But at the same time, what happens is, you have to remember section 282. In section 282, they have given to which addresses they can send the notices. To which addresses they can send the notices. There they have given the address given in the PAN number, the address given in the IT report, ITR, latest ITR, the address which is available in the so any other document which is available to the income tax department, like that. So they may send the notice, suppose without knowing you have filled the old address here, and you know that you are filing 3CD first, 3CB, 3CD first, and after that you are filing the ITR. So the person in your audit team, so the 3CD one person has filled up and other person started compiling the IT return. So what he has done is, whatever address is in 3CD, he copied to ITR. But remember, no one has checked what is the real address, what is the latest address, etc. Because we feel that at the time of examining, at the time of verifying also, when my article student brings this one, I say that, oh, it is a super silly, let me not verify. I will directly go to clause 9. But it is not like that. You need to fill the address also correctly, for the simple reason that sometimes, so the notice may be served on the old address. Of course, nowadays it is coming on the email also. Many people say that, okay, income tax department, let me forward. Or sometimes it is landed in junk mail. You would have not seen the email notice. But the sent to a wrong address and you have not taken action within a period of 30 days, etc., etc. The time limit is lapsed and they have done best judgment assessment. See, for a simple mistake, it landed up in best judgment assessment. Why I am telling you is, so I represented some of the cases where it happened like that. It is not the case only with me. So many of the people who are arguing with the tribunal, they have the same. They have the same experience. That is the reason. Even though they are basic details, so examine the backup document and carefully punch the data. So right. Then PAN number or other number. The clause for what it talks about is whether the assessee is liable to pay indirect tax like so and so he has given. If yes, please furnish the registration number, GST number, any other identification number, etc. So this clause is very dangerous. What it is using, whether the assessee is liable to pay. You should be aware of some basics, at least some basics of the indirect taxes, because here it has been given indirect taxes like excise duty, service tax. They may not be not there, but they are applicable only for very few industries now because of the GST. So sales tax, GST, customs, etc. So you need to examine whether he is liable. he is liable, what is the GST number allotted. So most of the times what happens when we are doing the audit, what happens is initially he says that sir, my turnover is less than 20 lakhs and I need not get the GST number, etc., etc. But at the year end, once we started compiling the data, so his turnover crossed already the threshold limit. At that time, what is your responsibility? So you have to disclose it appropriately here. So he is liable for audit, but he has not got any GST number. So that observation we have to clearly disclose. Now, what is the consequence? The consequence would be he will get a notice from the GST, or so what he has to do is he has to file the GST returns, etc., etc. So that is a consequence of this one, right? Then status. So you need to examine under which status he is falling. So to subsection 31, you need to refer under which status he is falling. You have to carefully fill this item also. Previous year so and so, assessment year, generally it is fine. Indicate the relevant clause of 44AB under which the audit has been conducted. So you need to see under which clause, because there are so many clauses, like now for example the Finance Act number 2 2019 has brought amendment to 44AB, where so they introduced a lot of amendments in that particular section. For example, up to 1 crore no tax audit, more than 1 crore generally what we conclude, yes, tax audit is applicable, but don't jump to that conclusion even if it is more than 1 crore, even if it is more than 1 crore. But so where it is not exceeding 5 crores, or we can say that where the turnover is falling between these ranges, and the cash receipts or cash payments does not exceed 5% of aggregate of cash receipts or aggregate of cash payments, then also tax audit is not required. So don't jump to a conclusion that merely because the turnover exceeds 1 crore audit is required. So you cannot jump to that conclusion because there are different clauses. So generally more than 1 crore tax audit is required. But there is a cushion. What is that cushion? More than 1 crore, but up to 2 crores turnover is there. You are willing to offer 8% or 6% as the case may be, then tax audit is not required. There is one more question. What is that question? Even though the turnover is exceeding 2 crores, but it is not exceeding 5 crores, and coupled with the condition that the aggregate of cash receipts, the cash receipts does not exceed 5% of the aggregate receipts. Likewise, the cash payments does not exceed aggregate 5% of total payments. In such case also audit is not required. So this has a lot of implication for very small software companies. So I am discussing with one of the partners in Prem Master's office. He observed that one. It means when we are sitting there, the article clerk has filled up. So the turnover is 3.5 crores. It is a small startup software company. The turnover is 3.5 crores. Tax audit is applicable. Let us start punching the data. Immediately we examined because at the partner level when we are reviewing. So what Mr. Mohan observed is, so it may be 3.5 crores, fine. But what are the cash payments? What are the cash receipts? Being a software company, and their cash payments never exceeded 5% of the total payments. Total payments in that year is 2.5 crores. 2.5 crores into 5%. So this 5% up to so your cash payment does not exceed this threshold. Likewise, cash receipts does not exceed 5% of the total receipts of the organization. Then in such case, audit is not required. Then immediately we stopped the article student. We asked, no, tax audit is not required. We will fall under that particular clause. See, you may say that, sir, what will happen if we do voluntarily? See, it is not like that. If it is not required at the last minute, now it is just to see another 21 days to go. So what happens is you are blocking one resource for the purpose of the things which are not required. So you need to understand, you need to carefully understand the particular clauses and you need to fill that one, right? The newly added clause is whether the assessee has opted for a taxation under 115BA, BAA, BAB. Okay. See here, 115BA, it is a little old section. So under 115BA, the entities has the option. So 25% is the tax rate where they forego certain deductions. that is 115BA scheme. That is a old one only, so you can keep that for for understanding purposes. Then 115BAA, 115BAB. These are the pretty new sections. The 115BAA and 115BAB. What is that one? Remember 115BAA, it talks about 22% of taxation. 115BAB, it talks about 15% of taxation. So far as 115BAA is concerned, that is 22% taxation is concerned. So you need to choose the option, and after choosing the option, remember that once you have clicked the 22%, you have to forego so many benefits. Like 115BAB also, you are opting for the concessional scheme of 15%, you have to forego so many benefits. So what are the items which I have to forego? Remember both the sections. Okay, so the MAT provisions are not applicable, but so far as transfer pricing is concerned, okay, so so far as 22% scheme is there, there is a TP issue. So far as 15% case is there, there is no TP issue. I have given the broad difference between 115BAA and 115BAB. It is not difference, just I have called out the in a tabular form for easy understanding, because many chartered accountants started calling, sir, whether we will lose the regular depreciation loss, regular business loss if we opted for this scheme. Remember, you will lose only the depreciation, unabsorbed depreciation or brought forward losses attributable to special benefits which are enumerated in the section. For example, 10AA is there. Yours is a SEZ entity. There are some losses. Those losses are carried forward. Now you want to move to new scheme. Why new scheme is beneficial? MAT is not there. Simple tax, 22% tax. See, normally even if you are an SEZ unit, MAT is applicable. So that is the reason they are given an option to you. Go for the new scheme, no MAT. As simple as that. So if there is any brought forward loss attributable to 10AA unit and you are switching over to new section, either 115BAA or 115BAB, then the attributable losses will be lapsed. So you have to forego those losses, only those losses. If it is a regular business loss, if it is a regular unabsorbed depreciation, then in those cases, yes, they are eligible. You are eligible to carry forward the regular ones. They are not impaired. So those rights are not lost to you. So you need to remember that one. And remember, so far as MAT is concerned, it is not applicable to both. TP is concerned, I don't know whether I covered or not. Okay, anyway, TP, 22% TP is not attracted, 15% TP is attracted. Sorry, 22% TP is not attracted, 15% TP is attracted. Right. Then, now let us understand the other class. Just give me a second. Yeah. So, class 9 and class 10. If firm or association of persons indicate names of partners, members, their P&L ratio, if there is any change in the P&L ratio since the last date, the particulars of such change. What is the relevance of this one? See, normally in the case of partnership firms, we give the names of the partners and the P&L ratio. If there is a change in the P&L ratio, that has to be indicated here. Sir, what is its relevance? If there is a change in the partners, what is its relevance? Remember, there are ABC of the partners, C is retired. Then you are filling up the data saying that earlier year ABC, now C is retired or C died, etc. Then in such case, you need to remember, then automatically section 78 will be triggered in. What is section 78? It says that so much of the loss attributable to the retiring partner, that is not allowed to be carried forward in the hands of the reconstituted firm. That is the reason why, so it is a direct fallout of clause 9. So clause 9, when you are filling up, remember that section 78 is triggered. If there is any loss, that loss has to be foregone. Accordingly, you change in your computation also. That is the reason you should know what is the implication of clause 9. Then clause 10. Clause 10 also nature of business or profession. And if there is any change in the nature of business or profession, the particulars of that change. So you need to give this also. Right. So why you want to give if there is a change in the nature of business or profession? So what happens is nowadays in CAS, of course, National E-Assessment Center, they are giving the notices. Recently, we got some notices for a couple of our clients whereby they have that the last year your turnover was 15 crores. This year turnover is only 10 crores. What is the reason? Then the SC replied that, sir, earlier I have retail business as well as retail business. Now, because of pandemic, not pandemic, because of any other some other reason, the retail business has been closed. Like that, he has given the reply. Then immediately, within a week's time, we got one more questionnaire saying that, sir, in your 3CD, that has not been mentioned. Clause 10 is silent. So we cannot call the article student and say that, oh, why you are not filled, why you are not asked the client, etc. So we have to, whether it is article student or whether it is chart accountant or me or whoever is punching the data, we need to ask the client. We need to spend some time regarding the basic details also. So we need to ask whether there is any change in the business. So this will have implication when there is a fall in the turnover, when there is a substantial increase in the turnover, etc. Right. Now, let us move on to class 10. Okay. See, 11 and 12, 11 will say, 11 talks about books of account prescribed, books of account maintained, and books of account examined. What are prescribed under the Act? It means what the Act says. Which books are maintained by the assessee? Which books are examined by the auditor? So it covers everything. What books are prescribed by the Act? What books are maintained by the assessee? What books are examined by the auditor? Right. Many article students, see, I am repeatedly using the word, don't get offended. Reason is it is only a student's session. That is the reason I am using the word students. Okay. It doesn't mean that, I don't mean that you are doing mistakes, but I am just saying that how to understand this particular class, as simple as that. Whether books of account are prescribed under 44AA. Everyone says that yes, they are putting yes. But remember, under 44AA, only for specified professions only books are prescribed. If your client is a specified professional or professional falling or pursuing the specified professions, for him only the books of account are prescribed. Okay. So for others it is not prescribed. For example, you are doing for a company which is engaged in manufacturing company. Turnover is 500 crores. You feel that, okay, turnover is 500 crores, so 44AA books are prescribed like that. No, it is not like that. Books are not prescribed for business assets. Books are prescribed only for specified professionals. So when you are doing compiling the data for business assets, you have to put the checkbox no here. Okay, don't put yes. Yes means only for specified professional. Okay. Then what are the books maintained and what are the books examined? So you have to give cash book, bank book, journal. Okay, purchase register, sales register, register book. Generally what we do is these are maintained in the computer and the above books are examined by the auditor. Same list books. Okay. Then that is all about clause 11. Clause 12. So clause 11, what is the caution you have to take is only for specified professionals under 44AA only the books have been prescribed. Then clause 12. Whether the P&L account includes any profits which are subjected to presumptive rate of taxation. So, so you need to give you need to choose the appropriate drop downs from here. Reason is very simple, because they are liable to the presumptive rate of tax. 44AD, you know that one, 8% or 6% case. 44AE, so the vehicles case. 44A, now it is subsumed into 44AD. 44B, shipping business of a non-resident. 44BB, So it is in relation to, okay. So 44 BB, prospecting, extraction, production of mineral oil. In relation to that business, anyone has supplied, the non-agent has supplied plant and machinery. 44 BBA, operation of aircrafts. So 44 triple B, so the construction business of the non-resident relating to turnkey power projects. Chapter 12G, like what you have to give is tonnage tax scheme. First schedule in the sense that first schedule, LIC, so the life insurance business or any other insurance business are maintained. Any other relevant section, it means there are other sections also other than this given in the drop down. So if you pick other, then you need to give under which section is covered. Okay, right. Now let us move on to the 13th one. So the 13th one, what it talks about is so method of accounting. Just give me a second. Yeah, method of accounting employed in the previous year. See, clause 13, it focuses on the ICDS. So the key point here is ICDS. Okay. The method of accounting employed in the previous year, generally it can be a cash or mercantile. Okay. Whether there is any change in the method of accounting employed vis-a-vis compared to the earlier years. So you have to carefully understand the impact of GST here. After GST, including professionals, what is happening to professionals also, within the completion of service, you have to give it a period of 30 days. Service means 30 days. In the case of supplier of goods, even before the delivery is made, the invoice is to be issued. So the chart accountants, everyone, suppose we are filing the tax audit report now, then December we are filing, then in January, by January 30th, we have to issue the bill to the client, strictly speaking. So which method of accounting I followed? I followed mercantile only here because I am raising the bill. Suppose he has kept it pending for 2 months, 3 months, etc. So I have to account for it as a, I have to invariably follow accrual, at least for the purpose of GST, because GST has made everyone to forcefully migrate to mercantile. So be careful, but still there are some assis, they say that we are following still cash basis. So examine the GST implication, those cases. Okay, right. So if answer to the above is I have seen many chartered accountants migrated from cash to accrual basis because of the GST. Then in such case, in the first year of change, we need to give its impact. So what impact normally? March month bills which are outstanding or any other bill which is outstanding, we will write as per the earlier accounting policy or method of accounting. These were not subjected to liable for tax in the same year, but because of which, because of following the new policy, new method of accounting, my profit is increased by so and so. So only the outstanding bills which are not yet realized but which has suffered tax, those impact you have to give. Like that, expenditure wise also you have to give. So that is so far as method of accounting is concerned. Then the next thing is clause wise impact of the ICDS. So DEF, 13D, 13E, 13F, you have to mention ICDS. 13D, what it talks about is yes or no question. Whether any adjustment is required on account of ICDS, that you have to give in 13D. Whether any adjustment is required on account of ICDS. So either you have to give yes or no. So examine whether the impact of each and every ICDS on the computation of your client. Then based on that you have to give yes or no. If the answer is yes, give item wise. What is item wise? There are ICDS 1 to 10. What is the impact of ICDS 1 on the profit? Because of ICDS 1, how much profit is increased? Because of ICDS 1, how much profit is decreased? What is the net impact? Like that. So you have to give ICDS 1 to 10. Then 13F, you have to give disclosures. So ICDS, there are 3 requirements. First, you need to give whether any adjustment is called for on account of following of the ICDS. That is the first thing. Then if the answer is yes, then what is its impact on on the profit or loss ranging from ICDS 1 through ICDS 10. Okay. Then disclosures 13F. What you have to give is what are the disclosure requirements as per ICDS 1 to 10? See, we have seen many reports, many we cannot say, but many people when they are signing this clause, it is not adequately documented, adequately reported. What happens here if you are not doing adequate reporting? Immediately it may be liable for 271J penalty. So later way I am telling you. So you are not filled up, your boss also has not focused on this one, then immediately your boss will be liable for penalty of 10,000 rupees. 271J talks about where chart accountant or any other so chart accountant etc. they are giving wrong certification. So 3CD also wrong particulars. Then he will be liable for 10,000 rupees penalty. So you have to ensure that adequate disclosures are there as per ICDS 1, ICDS 1 to 10. For example, if you feel that this is disclosed in the notes to account, then you have to give it here. ICDS 1, you write in one liner saying that the significant accounting policies are ABC. The details are given in the notes to account attached. Please refer para number 3.5, something like that. Ensure that whatever para number you are quoting here, that has to be there in the attachments. In the attachments, normally what we do, balance sheet, P&L account, etc. we will attach. So when you are doing the attachment, so those cases, what you have to do is ensure that whatever numbers you are giving, they are mapping back with the same numbers as given in the notes to accounts, etc. So the conclusion is ensure that the disclosures are adequate. If it is not, what happens is 271J penalty is triggered. Okay, right. So clause 14, method of valuation of closing stock employed in the previous year. In the case of deviation from 145A, the effect thereof on the profit or loss. So what it talks about is, see, 145A talks about or suggests the gross basis of taxation, gross basis of valuation. What do you mean by gross basis? The inventory, the purchases, the sales, etc. are to be gross of GST, gross of taxes. So if you are doing like that, what is its impact? Generally, its impact will be neutral. Generally, its impact will be neutral, provided he is a regular client. Regular client in the sense that he is complying with, not regular in the sense that every year he will come to you. Not like that. Regular client in the sense that he is complying with the GST laws also. Otherwise, what happens is, he has never filed the GST returns March onwards. Then in such a case, there will be an impact on account of this particular clause. Okay. So you have to be careful about this particular clause. Okay. Then, so give the following particulars of capital asset converted into stock in trade. So what it says, it is asking about the 45(2) adjustment. If there is any capital asset converted into stock in trade, generally it happens for many a times for real estate people, not real estate, one-time person, like he has ancestral land of 1 acre of land. So because of the real estate boom or whatever we call, so the land prices have gone up substantially. Now he divided them into various plots. Then he started selling them. So now earlier it is a capital asset. Now it became a stock in trade. But remember, even though it is treated as accessible for capital gains tax, but it is not taxable in the year in which the capital asset is converted into stock in trade. It will be taxable in the year in which the stock is ultimately sold. You know that one. So that is the reason the details are to be given. You have to give, okay, description of the capital asset, date of acquisition, cost of acquisition, amount at which the asset is converted into stock in trade, etc. You have to give. Okay. Right. So that is all about clause 15. Yeah. Clause 16. Amounts not credited to P&L account. It means generally what happens is, if at all, any item is directly taken to balance sheet, but it is falling under section 28, or it is in the nature of pro forma credit, drawback, refund of customs, excise, or refund or any other refunds. Escalation claims accepted during the year. Any other item of income or capital receipts. So, amounts not credited to P&L account. First of all, the amount should not have been credited to P&L account. And if it is of the nature given under section 28 or indirect tax benefits or escalation claims or any other item of income, it means it is an item of income but is not routing through P&L account, directly is taken to balance sheet. Those items are to be disclosed here. Likewise, capital receipts are also to be disclosed here. Okay. Right. What is its impact? Let us understand at least one clause related to this one. See, when I am punching this, when I am comparing this, just see, one person asked me this, and I am explaining for the benefit of you. What is that one? Is electricity bill 5 lakh rupees, and the department has given, electricity department has given you a subsidy of 1 lakh rupees. So the net amount is 4 lakh rupees. Sir, what he has done is power bill, instead of showing it as 5 lakhs and offering income as 1 lakh, what he has done is 5 lakhs minus 1 lakh only has shown. Whether that will come under no. My view is the answer is no, because amount not credited to P&L account, it is reduced from the expenditure, means automatically indirectly credited to P&L account. The intention of this particular clause is the item should have been touching the P&L account, but it was first 4 clauses, but it has been directly taken to balance sheet. Then in such cases you have to give. See whether it is so section 28 item but not rooted in the P&L account, whatever may be the reason, that you have to give. Likewise, indirect tax benefits, if you are received, you are not routing through P&L account, you are directly taken to balance sheet, whatever. Okay. Escalation claim, any other item of income or capital receipt. You may get a doubt. So capital receipts are directly, can I take to balance sheet? Yes, you can take, but since you are not taken to P&L account, you have to show it here. We are not asking about whether the account treatment is correct or not, simply whether it is a capital receipt. Yes, it is a capital receipt. It has not been credited to P&L account. Okay. So if you are directly taken to balance sheet, that you disclose here. Okay. Next. So clause 17, it talks about the 43C adjustment and 50C adjustments. What do you mean by this one? Where there is any transfer of immovable property, either kept as capital asset, either held as capital asset or held as stock in trade, and if they have been transferred for lower than stamp duty value. But remember, there is a 5% concession which have been given now. So where the actual consideration, the difference between the actual consideration and the stamp duty value does not exceed 5% of the actual sales consideration, then in such cases you need not or 43CA provisions or 50C provisions are not attracted in those cases. Okay. So what you need to report here, where any land, building, etc. is transferred during the previous year for a consideration less than the value adapted or assessable. Okay, then so first of all, whether it is lower than the stamp duty value. If the answer is yes, details of the property, consideration, value adapted. This you have to give. Okay. So now you have to read it as 105% of the actual consideration versus stamp duty value. If the answer is affirmative, then only you have to report here. No sir, the stamp duty value is 45 lakhs. I sold for 55 lakhs. Then you need not report that under this particular clause. Remember, the objective of 3CD is, if you see the guidance note, if you see the section backing, everything, the objective of the 3CD is not helping the client. It is assisting the assessing officer in framing the assessment order. It means you are helping the assessing officer. You are reading, you are reporting, saying that, sir, there is a transfer of immovable property that has been transferred for a consideration less than the stamp duty value. You report immediately, directly based on clause 17, assessing officer. So immediately will examine whether any adjustment is there in the computation or not. He will search in the computation. You will search in the ITR 6 or ITR, whatever relevant ITR. If it is not there, then he will make an adjustment. He will make an adjustment. So the objective of class 17 is, objective of entire 3CD is assisting the assessing officer, not the assessee. You cannot say that sir, assessee is requesting not to report. So if he is requesting, you, your boss and myself will be under big trouble. We have to be very, very careful. He may be a close friend of us, assessee, but sorry, we should not entertain those things, right? Clause 18. Clause 18, it talks about particulars of depreciation allowable in respect of each block of assets. So you check there. What are the things required? So for ITR purposes also you will compile this data. So you need to report the same. But the data will be slightly different in ITR and here. But broadly the working will be the same. So you give here. Okay. But the thing what I want to highlight is you just see here CA and CD. This is newly inserted. This item I will explain. Adjustment made to the WDV under 115BAA. Adjusted written down value. So what is this one? Adjustment made to the WDV under an account of 115BAA. So what is this one? See, when you are migrating to a new scheme of taxation 115BAA, then what happens is, because of that one, there may be a case. The additional depreciation is not fully allowed in the last year. For example, last year you purchased an asset, plant and machinery. You complied with all conditions relating to additional depreciation, but the asset is installed and put to use for less than 180 days. Then in such case, you would have given 50% of additional depreciation. The remaining 50% logically that is allowable in the current year. But in the current year, you are migrating to the new scheme. When you are migrating to the new scheme, what happens? Any benefit of additional depreciation is not allowed. Sir, I claimed only 10% in the last year. Now I am eligible for the backlog of 10%. We are not talking about current year. Current year anyway it will be gone. Okay. The backlog of the earlier year, 10% is there. So what as a relaxation they have given is, since it is a benefit, you adjust, you increase the block to that extent so that you can claim over a period. So instead of writing it as a one-time depreciation, you are adjusting the block. So that is my view on this particular clause. Right, now let us see the next one. 19. So what are the various deductions ranging from 32AC to 35E? I have given only few, and like that the section goes on up to 35E. But what you need to do is amount debited to P&L account and amount admissible as per the IT Act. Your client is eligible for 35D, preliminary expenses. Then keep ready the workings and ensure that it is allowed only for 5 years. Many a times what we do, we see is, article students or whoever is compiling, last year preliminary expenses 150 is allowed, last year figure is there, I will take the same figure. But examine, after 5 years it is not allowed. So many a times we observed this mistake. The 6th year, 7th year also they claimed. Of course 6th year also it missed our order also. Then 7th year we realized the mistake and we voluntarily offered in the adjustment. Okay, so we adjusted. So ensure that the workings are there. Okay, then you are not crossing the period which is given over these particular sections. If it is a one-time benefit, definitely fine. Okay, it is simple to calculate. But if it is having impact over a number of years, then always in the computation, in your own computation, write as a remark so that you remember. Total amount eligible as preliminary expenses under 35D, 5 lakh rupees. Amount eligible 1 lakh rupees. First year dash assessment year 18-19. Second year dash 18-19-20. Like that, computation itself. In the first year you make that one. You keep that note for future years also, so that when you are compiling the data, the next staff, whoever is succeeding you, they won't do the mistake. Okay. let us see clause 20. So clause 20 is 20 onwards till 25. See, of course, all clauses are important. Here, lot of time you need to spend on particularly clause 20. What is that one? Is some paid to an employee as bonus or commission for services rendered. Okay. See, 36(1)(2), if it is there, that has to be reported under clause 20, clause A. Serial number 20. So what is this one? You are giving a bonus or commission to an employee, but that is a hidden dividend. Actually, that is representing a dividend. That is, in the substance it is a dividend, but you are changing the nomenclature and you are declaring as if it is a special bonus or special commission. Those cases, you have to give that amount here. For example, there are 4 directors in a company, in a private limited company. 2 are executive directors, 2 are directors, normal directors. And these 4 persons are the shareholders. These 4 persons own the entire share capital. Then, so they want to declare a dividend. So what they have done is, instead of declaring it as a, so what they have done, so they want to declare it as a dividend for the 4 shareholders. So first year what they have done is, sir, if I declare it as a dividend, first 2 executive directors, what I will do is, I will give it as a special commission. For the normal directors, I will declare it as a dividend. They want to make adjustment of the float between the rate of taxation or whatever. Going forward, it won't be there. Reason is dividend is also taxable in the hands of the assessee only. Okay. So then in such case, so in the substance it is a dividend, but it is reflected, reported or characterized as bonus or commission. Those cases you need to report under clause 20A. Then clause B, what is this one? So 36(1)(5)A, remember I have seen most of the cases some mistakes have been done here. 36(1)(5)A, it talks about only employees' contributions, staff contribution, how much he has contributed to ESI, how much he has contributed to PF. So what are the recovery, what is the due date given under the respective act, and when it is actually paid. That's it. So you have to give the entire thing, like entire thing for the entire all the months you have to give. So for April month, staff recovered from staff 5 lakh rupees. The due date of remitting is 15th of next month. The actual remittance is 18th. Like that you report, as simple as that. Okay. So once you have done this one, based on that, so adjustment notices will be proposed under 143 1A. There may be some judgments of the courts whereby they held that if it is paid up to the due date also will give relaxation. That litigation separate. But as when we are signing, here it is asking what is the due date, what is the date of remittance. They are not asking whether it is allowed or not. Allowed or not, the department will take care. So you have to report the facts only here. Right. Then 21A, any capital expenditure is debited to P&L account, you have to report here. Any personal expenditure debited to P&L account, you have to report here. Okay. Any advertisement, expenditure at clubs. Okay. So expenditure by way of penalty or infraction for law, penalty or fine not covered above. It means penalty for infraction of law, you have to report separately. That will be directly disallowed. Some other penalty in the sense that you paid very lately to state controlled organizations. State controlled, like for example, your client is a supplier to Power Grid Corporation. He is supplying transformers. There is a delay in the supply. Then what they do is they will levy liquidated damages. They will levy sometimes as a fine. They will levy as a penalty. So penalty for violation of the contract can also be reported here because it says expenditure by way of any other penalty not covered above. So in my view, so So those items will also be reported under this particular clause. It won't attract any disallowance. See, what will be attracting disallowance is only penalty and fines for infraction of law alone. If it is an account of breach of contract, they will be allowed. But only for reporting purposes, they want to understand. That is the reason. Okay. Expenditure incurred for any purpose which is an offence or prohibited by law. That also we have to give here. Okay. Then amounts inadmissible under, see, still we are under clause serial number 21. 21, what it talks about is amounts inadmissible under 40 clause A. 40 clause A, it is a very big section. It says that as a payment to non-resident referred to in subclass 1, it means 40 A subclass 1. What it talks about? Payment to non-residents. So, sir, I am making this much of payment to the non-resident. I have not deducted TDS. It means your client has not deducted TDS. Then in such case, you report under box A here. Box B, what you will report here? The box A talks about TDS is not at all deducted. Box B talks about TDS is deducted, but the remittance is not done up to the due date for filing return. Then in such case, box B will be given. Okay, in box B it has to be given. Right. I repeat, in box A, TDS is not done at all. Then in such case, box A. Box B, TDS is done but not remitted on or before the due date for filing the return of income. Like that. Okay. Right. So the next one is okay. As payment referred to in 1A. See, clause 140A 1A, it talks about payment made to residents, whereas 40A subclass 1 talks about non-residents. Here various TDS defaults we have to give. Likewise, here also TDS is not at all deducted, fill in box A. TDS deducted but not remitted, fill in box B. You may get a doubt, sir, up to which date I need to consider? Since you are filing the 3CD, 3CB in advance now, the return due date is something late, January, but December 31st you have to close the 3CB. So as an auditor, you consider only up to 3CB only. Okay. If he has done later, okay, then he will make adjustments in the return if it is allowable. Then amounts inadmissible under other classes: 40A 1C, 40A 2A, 40A 2B, 40A 3, 40A class 4, 40A class 5. So there are various other sections like income tax is not allowed as an expenditure, taxes paid outside India is not allowed as an expenditure. So 40A 3 talks about salary TDS. Okay, so these are the various clauses where it is not, so it is liable for disallowance. Then you have to report class wise. Then next box we talks about 40B BA workings, in the sense that suppose you are doing an audit for a AOP or a partnership firm. Then in such case you have to give what is the amount which is inadmissible. So only inadmissible portion only you have to give here. Okay. So that directly we will copy this one in the, he will examine whether this much is disallowed in the return, and he will cross check with the return. If it is not done, he will send 143 1 year adjustment. Disallowance under 40A3. See, what is 40A3? 40A3 talks about the payment or aggregate payments exceeding 10,000 rupees. Aggregate payments made in a day is exceeding 10,000 rupees and they were paid otherwise than account pay check, whether on capital account or revenue account, they have to be reported here. Okay, revenue account report here, because capital account they will be adjusted under fixed assets block. Fixed assets block. Yeah. Just a minute. Okay. I will stop sharing and reshare the screen. It is not visible. Just give me a second. It is visible now. One minute. Is it visible now? Just give me a second. Right. So one. Just a second. It is not allowing to maximize the screen. Just give me a second. Done that one only. I have done that one only. Just okay, just give me a second. Yeah, is it visible now? At least 3CD 40A3. Yeah, right. Okay. Yeah, right. Okay. No, in my screen it is appearing differently, so that's the reason. Okay, fine. Okay. Disallowance under 40A3. What is that one? It is asking 40A3 cash payment exceeding 10,000 or aggregate cash payments in a day exceeding 10,000 and so the cash payments etc. And it is not covered under Rule 6 DD exceptions. Those items are to be reported here. Remember, here only revenue items will be reported. If it is adjustment to capital asset etc. So you do an adjustment in the capital, the fixed asset schedule itself. So the new requirement is okay. So what it is asking is, if you are making payment to a person in cash, if PAN or Aadhaar is available, give that PAN number and Aadhaar number of that person's name and PAN number etc. See, for initial years it is made optional. I personally believe that going forward it may be made mandatory. Okay, so that one is to be reported here. So disallowance are deemed income under 40A3 on the basis of examination of books of account etc. So you have to report. One is 40A3, another is 40A3A. 40A3 is payments are, see, both are linked sections only. 40A3 regular payments. 40A3A, it means they are routed through balance sheet. It means in the last year what you have done is you purchased raw material. Okay, so and you have not paid to that person in the March month you have purchased. So you purchased raw material for 1 lakh rupees. What is the entry you would have posted? Raw material account debit to supplier account. Then it is sitting in the balance sheet now. Next year what you have done is on the same day, April 3rd or 4th, entire 1 lakh rupees you have withdrawn from the bank. That person asked, sir, I want cash only. You are given. Okay. That will be reported in SFT portal. I am not talking about. So what is the requirement under this particular category? So what happens is, you may argue, earlier people started arguing, sir, it is not debited to P&L account at all. So I need not disallow. But 40A3I is there. It says that even though it is rooted in the balance sheet, if it is not disallowed earlier, now it has to be disallowed. So that one. Then 40A7 gratuity. 40A7 you need to quantify what is the provision for gratuity which is not allowable. So see, many a times people ask, express this doubt that, sir, as per AS 15 I have done the valuation, I am making the provision. See, whatever provision you are making as per AS 15, that has to be disallowed. That has to be disallowed. So 40A7 is to be disallowed. 40A7 it allows only actual payments or payment to a recognized fund or provision towards an asset and liability. For example, March month, one senior staff resigned and you have to pay around 20 lakhs gratuity to that person. And you are saying, sir, please come after a month. In April month, I will give retirement benefits, etc. Little later, after 1 month. Sometimes some organizations do that one. I will give salary, etc. now. After 15 days or 20 days or whatever, 1 month I will give. Then you make a provision in the books of account because that person already retired on March 31st, but you are actually making on April 15th. Whether in such case it is a provision, whether that will be disallowed or not, no. It will be allowed even under 48(7) for the simple reason that it is a provision towards actual expenditure. Nothing but accrual. Okay, so that is the reason it is allowed as a deduction. So 40A9, any sum paid by the C as an employer, not allowed under 40A9. It means if your employer, it means as an employer, if the if the company is contributing to any unapproved welfare funds, then in such case those are to be disallowed. They have to be reported here. Particulars of liability of a contingent nature has to be reported here. Okay, but just see the heading, what it says. Please furnish the details of amounts debited to P&L account. A. Amounts inadmissible. Okay. Then C. Amount debited to P&L account being salary, etc. Disallowance. Then E. Yes. Yeah. Particulars of any liability of a contingent nature. So if any contingent liability is there, just report here. Amount of deduction inadmissible. See, contingent nature, just report here. That is all. Okay. You need not qualify whether it is allowed, not allowed, rooted in P&L, etc. Particulars of contingent liability. That's it. Amount of deduction inadmissible under 14A. So 14A, if something is there, so if any expenditure is incurred towards earning exempt income, then you have to calculate the disallowance, then you have to quantify and give. So amounts inadmissible under proviso to 36(1)(3). So those cases, interest, so that has to be given here. If there is any interest which is disallowed. Okay. Amount of interest inadmissible under 23 of Micro Act, that has to be given. So 40A to be, so payment to relatives. See, you need not quantify whether it is allowed or not. Just you have to give, so far as class 23 is concerned, what is the payment made to the person of the nature specified under 40A to be. That has to be given. Okay. Then amounts deemed to be profits and gains under various sections. 32AC, 32AD, 33AB, 33AB, 33AC. These sections talk about if the conditions given therein are not complied with, then it will be treated as a deemed profit. That profit you have to give here. Next one. Any amount of profit chargeable to tax under 41 and computation thereof. So there are so many subclasses. If you see the actual utility, it will allow you drop down facility also 41(1), 41(2), 3, 4, 5. So 41(1) talks about recovery against deduction. 41(2) it talks about balancing charge. So 41(3) sale of R&D asset without bringing to business proper. So 41(4) recovery against bad debts. So 41(4)A withdrawal from special reserve. 41(5) adjustment of losses in the case of discontinuance of business or profession. So those cases you have to report separately clause wise. Okay. Yeah, Team SICASA, can you confirm whether it is visible? Praveer, are you there? Hello? Okay. Praveer, is it visible, Praveer? Class 26? Slide slide number 20 number. No, what is the serial number? What is appearing? Can you read? No, just read the first line. It's not changing. 1 minute, I will reshare the screen because I am right now in class 26, Praveen. Is it visible, Praveen? 1 minute. Just give me a second. I will convert it to PDF and share, so that because next class is a little complicated. Yeah. Yeah, whether PDF is visible? No? Yeah, I scrolled to the next class. No, when I'm scrolling, it is hopping. Yeah. Okay, right. Okay. Yeah. 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 Sorry, students. Okay, I did not observe that it was not visible. Yeah, right now we are in a class 26. Okay. What it is talking about? So 26 it talks about 43B. See, here again Some people are reporting only March month payments. Some people are reporting the entire year. But just read this language. I will tell my view. In respect of any sum referred to in so and so of Audit 3B, the liability for which pre-existed on the first day of the previous year. So box number A, it talks about the opening disallowances. It means it was disallowed in earlier years, and since it is paid in the current year, that is getting allowed in the current year. So in such case, that will be reported in this box A. Then box B, what has to be reported? Read once again. In respect of sum referred in so and so, the liability for which was incurred in the previous year and was paid on or before the due date. So since many people are taking introduction, since they are talking about only liability generally will be there only in the month of March, assuming that all others are paid. So it is enough if they disclose only March month. Okay. So my view is also, if you disclose March month, assuming that others are paid, that will be enough. Otherwise, February, March are not yet paid, or whatever are outstanding as on 31st March. With regard to that, you offer comment so far as box B is concerned. So what they are talking about in the box B, what they are talking about is it is incurred and it is paid on or before the due date for filing the return and not paid. It means out of the outstanding amounts, how much is paid within the due date and what is the amount not yet paid. So immediately what happens is whatever amount is not paid, that will be the thing also will cross-examine with the ITR form, and if it is not made as a disallowance, he will make the disallowance. Okay. So in part B, when I am explaining, I will walk you through the super silly mistakes. Then part C, what I will spend some time on the cross-linking. What clause of 3CD is to be cross-linked with the ITR. Okay. Then the next one is 27. Amount of SENVET availed or utilized. Of course, because of GST, this 27A is redundant now. 27A is redundant now because we will report directly in class 44, that is GST related. Of course, GST is also for the current year, it is kept in abeyance. Then, what 27B, what it talks about? Prior period income, prior period expenditure, which is debited to P&L account. You need to certify it. So if it is a prior period income or prior period expenditure, you need to quantify and give. See, whatever is there in the financials you can, but you need to test check whether whether there are some other items which are sitting, which are not properly reflected, etc. Then 56 to 7A also, this clause is not there for the current year because 56 to 7A clause is subsumed into 56 to 10. So 27A not there, 28 also not there. 29 is there. So 29 talks about 56 to 7B. 56 to 7B is there. So this is applicable in the case of closely held companies. The closely held companies are issuing the shares for a premium, number one. And the whatever amount they are receiving together with the premium is exceeding the fair market value. Fair market value as determined under rule 11U, 11UA, 11UAA, UAB. So those rules are given. Just check because those 4 rules or 3 rules are relevant to compiling the data with regard to this one. So the first and foremost condition is the company should have issued shares at a premium and the amount received is exceeding the amount as per the valuation certificate or the fair value which is high. So though it is crossing, it is exceeding more than the threshold of the amount, then in such case you need to report under this particular category. Okay. Then 56 to 9 also you have to give. What is 56 to 9? 56 to 9 it talks about you entered into any negotiations, not your client. Your client is a supplier of machinery, etc. Whatever. Okay. Okay. So the other, then in such case, what happened is you entered into negotiations, and it means your client is selling some machinery, capital asset, building is selling. Suppose that he is selling building. So other person has walked in and he has given 5 lakhs as advance. Later on the agreed, that person did not turn up. Then your client says that this 5 lakhs advance will be forfeited. So where the negotiations took place, but there is no transfer on account of which the amount is forfeited. That became your income. That became your income taxable under 56(2)(9). That amount which you report under serial number 29A. Likewise 56(2)(10). Here we will report to the various gifts covered. So cash gifts are covered, immovable property is covered, notified movable property is covered. Okay, so it is not covering all types of notified movable assets, only particular movable assets like share securities, jewelry, archaeological collections. Okay, and then works of art, sculpture. Okay, so these are the items which are covered under 56(2)(10) movable assets category. So it doesn't cover any other item. Okay, because property definition you check under 56(2)(10). Okay, then 30 is not very much relevant. Details around borrowed on hundi or amount due thereon otherwise than account paycheck. So hundi concept is not prevalent in most of the places, so you can ignore that one. Then 30A. So what it talks about is whether a primary adjustment to transfer pricing has been made during the previous year. So where there is a primary adjustment, if the answer is yes, then you have to fill clause B saying that under which section primary adjustment is made and how much is the quantum of the primary adjustment, then whether the amount is liable to be repatriated to India. If the answer is yes, how much they are repatriating within the prescribed time, because 90 days from the prescribed time they have given. If no, amount of deemed interest. So you have to calculate and give. So just let me spend 2 minutes on explain this particular class. Some of you may you are opposite to this particular thing also. What is this one is, in the transfer pricing, there is a primary adjustment done. Primary adjustment is done by nothing but your computation is not accepted by the department. So there are various types of adjustments, like you can voluntarily say that yes, this is the, so the industry says that 18% is to maintain, I maintained only 15%, or the assessing officer proposed 3% variation, you accepted for it, or you fought with the DRP or tribunal, you lost and at that time you accepted, or High Court or Supreme Court level, wherever. So at different stages you accepted. It reached a finality. It means the TP adjustment should not have been under litigation. First of all, there is a TP adjustment and it is not there under litigation. It means it reached the finality. After reaching the finality, it means there is no more dispute. You need to bring that much back to the Indian tax authorities. If you are not bringing, then there will be a secondary adjustment. What is the secondary adjustment? So the department will add certain thing. So it will add whatever amount is there. They will add interest on that quantum because it is treated as that amount has been given to your associate enterprise outside India for interest free or as interest free. So they will calculate imputed interest. They will calculate. So in that context, if it is applicable, you have to fill up this particular data. Okay. Then 30B, what it talks about. So 30B talks about thin capitalization rule. So again, yeah. So if there is thin capitalization, then you have to report under this category. So what is thin capitalization? Remember, this thin capitalization concept is applicable only to the loans or borrowings or the guarantees, etc. They have been taken from non-resident associate. If you are taking from a resident associate, this section is not applicable. First of all, you need to remember. Then where the interest payable to the AE is exceeding 30% of the EBITDA, then it will be disallowed and it will be allowed for a period of 8 years. So if, that is called the thin capitalization rule. If it is applicable, you need to report under this category. If you are not understanding, you have to consult your boss, the principal, and ask that, sir, what is this meaning of this particular thing? See, because you are exposed to so much of data, and you have the opportunity to punch and to learn. Okay, right. Then the next one is 30C 96. This is also in abeyance. This is nothing but GAR provisions. It is not applicable for the current year. Okay. So whether the SC has entered into any impermissible avoidance agreement, yes or no, you have to fill up. Okay. Then, yeah, 31A 269 SS. One is accepting. There are three sections: 269 SS, 269T, and 269 ST. In all these three cases, reporting is under two categories: at the time of acceptance, at the time of repayment. Okay. So what it talks about is in all these classes. Okay. In all these classes, first you understand about these particular sections. Then what are the broad requirements of these classes? I will explain in broad terms. See, 269 SS, 269T, 269 ST. Based on the report given in the audit, it results in huge penalty, because under 269 SS, 269T, 269 ST, there is no disallowance concept, but it leads to 100% of the penalty. 269 SS, what it talks about? So accepting loan or deposit. Okay. So accepting loan or deposit otherwise done through banking channels. Then 269T, repayment of loan or deposit otherwise done through banking channels. Then 269 ST, incurring the cash expenditure, cash expenditure in excess of 2 lakh rupees, in excess of 2 lakh rupees, either with regard to a single event or on a single day, single transaction, like that. So you need to examine whether any disallowances, sorry, not disallowances, whether any violation of these particular clauses have taken place. If the answer is yes, then you have to report appropriately under these particular clauses. So that is a broad requirement, but you have to be very, very careful about 269 ST. Reason is it is event linked. So with regard to a single event, if the total amount is exceeded 2 lakh rupees, even though it is paid to multiple persons, but it is a single event, then also 269 ST is attracted. Then as a cross referencer, you have to examine SFT also. Okay, so statement of financial transactions, SFT reports, Form 60, 61C, 61B, you will be filing. You have to cross check with that one. Okay. Then details of brought forward loss or depreciation allowance in the following manner to the extent available. So 32 talks about brought forward losses you have to give. Okay. Then the impact you have to give. Then the impact you have to give on account of 115BAA also. I told you what is the impact on account of 115BAA. Additional depreciation. Last year you claimed only 10%. This year you have not claimed the remaining 10%. So that percent is to be adjusted to the gross block. So those along with the adjustment also you have to give. Then 32 class, what it talks about is, this is 79 adjustment. 79 what it talks is change in the shareholding pattern. In the closely held companies there are two types: normal closely held companies and eligible startups which qualify for a special concessional treatment. But normal companies I'm telling you. Okay, so if there is a change in the shareholding pattern, okay, such that not less than 51% of the, see, there is a change in shareholding pattern. The provision of section 79 says that not less than 51% of the voting power as on the last day of the previous year in which the loss is arising should have been in the hands of the same set of persons as on the last day of the previous year in which loss is proposed to be adjusted. In simple terms, in the year of loss, the shareholding pattern you examine. In the year of adjustment, you examine the shareholding pattern. If there is a change there, and the change is accounting for more than 51%, then that loss will be lapsed. That loss will be lapsed. So that is the provision of section 79. So you have to give that particular the impact of losses under 79 under this particular 32 clause B. Then 73 losses also you have to give. It means speculation losses. If there are anything, you have to quantify and give. Remember, for company assessee, if they purchase shares and whose objective is not trading in shares, it is not an investment company, it is not a banking company, then in such cases, it is a normal company. For example, take Infosys. So Infosys purchased, assume that the shares of Reliance. They have taken delivery. Their intention is to hold for long term. And after some time, not long term, for a short term. They want to trade frequently in so many scripts, including Reliance. Then in such case, even though they have executed, they have purchased and sold, they have taken actual delivery, yet it is treated as speculative transaction. For the simple reason that explanation to section 73, if you see, it says that in the case of corporate associate, other than banking, other than share broking business, etc., whose objective is trading in shares, etc., those cases, normal companies, where the income is falling under the PCBP, business or professional income, and if they get any losses on account of dealing in shares, then that will be reported as a speculative loss. Okay, even though they are taking deliveries, normally intraday trading only will be treated as speculative, but for company associates that will be treated even though they are taking deliveries. For normal companies, if they are purchasing and buying or selling shares of other companies, then in such case it will be treated as a speculation loss. 73A also, okay, that's why there are separate clause C and E. Okay, D clause 73A we have to quantify and give. What is 73A quantification is 73A quantification is specified business losses are there. Warehousing, there are various sectors in investment linked incentive. So if your client is claiming any of the 35 AD benefit and he got losses and he want to carry forward for indefinite future, then in such case those losses are to be quantified and given under 73A. Okay, 33. Then again here there is a detailed drop down. Chapter 6A deductions, what are the various chapter 6A deductions are there, and various benefits under 10AA, etc. You have to give item wise, so under which it is claimed and amount admissible. So as an auditor, you have to examine whether you fulfilled all the conditions or not. And one more point is you have to ensure that the relevant form is properly filed. For example, if you are claiming for 115 BAA, 115 BAB, 10 IC, 10 ID, new forms are introduced, 10 IB. So examine the proper form. That form has to be filled even before filing the return. Likewise, 10 AA, so examine 56F is filed or not. Like that, your client is claiming 80IA, IB, etc. The form 10 CCB should have been filed. So the relevant forms should have been filed in appropriate cases. Yeah. Then TDS, so you have to give. So you have to align these with form 27 or 24Q, 26Q, etc. Whatever you are filing, you align with them. But there is a lot of practical challenge. Prem sir could not attend today's session, so he has done a wonderful presentation how to pull the data with regard to this one. Okay, in brief I will explain. Okay, I am not that expert as Prem sir. Okay, I can interpret the class. I depend on my staff to pull the data. from the Tally or any other accounting package or whatever. Okay. So the clause, the requirement of this particular clause broadly is okay. What are the total amounts which are subjected to TDS, and which component of the amount has been subjected to TDS, and how much is not subjected to TDS. So the simple thing is you have to align them with whatever the various monthly or quarterly returns you have filed. You align the data with those things. Okay. But when you are compiling the data, this is one schedule which takes a lot of time. I know that one, I very much appreciate. But for me to explain, it is a very simple thing. Simple thing is, okay, pull the data and keep in the format which is required here. Okay. Right. So whether this is required to furnish TDS or TCS, here you are giving the forms. It means what is the due date for filing the quarterly or the TDS, ETDS return, ETSS return. Then you have to give the due date of furnishing and what is the actual date of furnishing. Then you have to give whether all the details which are required to be reported has been given in the form or not. These are dangerous clause. It means you have to examine every quarterly TDS returns and you have to see whether all the data have been properly reported or not. If it is not, you have to give it here. Okay. It looks like a very simple one, but it takes a lot of time in compiling and verifying this particular thing. Likewise, if there is any interest under 206, 201 year, 267 there you have to give. So the next one is 35 quantitative details of the principal items. Trading concern principal items, so manufacturing concern everything principal item. Quantitative details you give. Earlier we are picking up the data from the normally companies used to give. Now the company's requirement also changed. Many people they stopped reporting some of these things in their internal, but for 3CD purposes we are maintaining and this has been continued for a couple of clients. When we observed that they discontinued, immediately we alerted them to keep maintaining the data. Okay, that is in a different context. Okay, right. Anyway, from next one is 115O. Of course, this is the last year because the next year onwards it is taxable in the hands of the shareholder. So tax on distributed profits under 115O you need to report under this particular column. Okay, dividend distribution tax details you have to give here. Then this also last year 222E dividend. So very loans or advance are given to a shareholder who is having substantial beneficial cum registered ownership of more than 10% in the closely held company. That loan or the loan or advance will be characterized as deemed dividend. So that amount has to be reported here. Remember, even if the director or whoever the 12% holder has repaid even before the due date for filing return, there is no other go. It will be treated as a deemed dividend only. Then clause 37, cost audit report, the disqualifications, etc. if there are any. So those are to be given here. Then likewise, okay. Then if there is any central excise audit, see now GST audit may be there, but CE audit for your clients there may be ongoing assessments under the central excise and service tax. So you have to give report here. So you have to report if there is any audit. Normally what is the procedure there in indirect taxes is, once they conduct the audit they will give you audit objections. You have to give the audit objection paragraph. It means what is the client view. Here as an auditor what you have to do is, as per the department perspective, what is the disqualification, what they have given, what is the disqualification or disagreement, what is the disqualification which they have given, what is the view of your client. So normally we give both here. So the department is of the view that it amounted to job work, that's why it is liable for service tax, not liable for central excise, like that they give. But the client sometimes may argue that no, It is amounting to manufacture, it is not amounting to service, because of even though the rates are same, sometimes the alternate argument would be beneficial from financial the monetary perspective. That is the reason. So what is their objection? What you have given. So those has to be reported here. Then 72 here like that. So here clause 38 talks about CA audit. Clause 39 talks about service tax audit. Then clause 40 turnover you have to give. Okay, so the ratios you have to give. Be careful when you are giving the ratios. Compare with the last year. If there is any too much difference, go back and check your workings. And see, it doesn't mean that there should not be differences. Definitely there can be. But you should know why there is a difference. Reason is very simple. Based on these differences, 142 notices will be generated. That will be sent to your boss. It means the client. The client will immediately come to chartered accountant and say that, sir, I got this notice. What to report? Then you have to understand. At that time, searching may be difficult. That's why. So it will give so much of alerts. The moment. So last year the GP ratio is 22%. This year it is 14%. Then you have to examine whether stocks have been properly reconciled, or whether why there is a bump in the expenditure, whether there is a huge hike in the expenditure, or whether it is a downfall in the revenue. What is the reason? Something like that. You have to make some summary sort of thing, so that you yourself satisfy. Later you can justify before the departmental authorities. Okay. Right. Then let us move on to clause 40 ratios. I told you 41, 61B, 61, 61 and 61B. This is sorry, 41. It talks about please furnish the details of demand raised or refund issued during the year so and so, other than income tax, wealth tax, along with the details of relevant proceedings. So any other demands, like under any other law, if it is being given, you quantify and give. Okay. Then so that they will examine what is its implication under the Income Tax Act. Okay. Whether the assessee is required to furnish the 61, 61A, 61B, immediately you examine the compliance portal also. There is another portal called compliance portal. In the compliance portal, the due dates will be given, 61, 61A, 61B, what amounts have been reported, so whether any cash sales are there, whether it is properly reported or not. So examine the thresholds given under there. Then therefrom you examine and cross check under this clause. Then whether the assessee or its parent entity or ARE liable, so and so. What is 43A? 43A talks about the CBCR. See, it is not asking the master report. In 3CD we talk about only CBCR, but in ITR we talk about master return, master file, local file, and the CBCR also. But 3CD talks about only CBCR, country by country reporting. So for this year, how much is the threshold limit? Where the group's turnover is more than 5,500 crores, and you are forming part of that group, and you have been designated as the reporting entity, or you yourself is the parent entity, and if the answer is yes, CBCR you are liable, then you need to prepare this data. It means, so CBCR contains the top 5 or 6 matrices, top 5 numbers. Okay, so those amounts are to be given here. Okay, so amounts, so here the details of the CBCR are to be given. Okay, name of the entity, what is the date, etc. you have to give here. 44, this clause is not applicable for the current year, because under GST it is applicable for the next year. We will see at the time. Okay. Now, so with this, the detailed explanation of Form 3C D is over. Okay. Now let us move on to the next thing, part B. I will explain some of the common mistakes which many people have done, because of which they are arguing, they are in front of the tribunal, they are in front of the Commission of Appeals, because they find it very difficult to convince the CPC, to convince the assessing officer, and it went into litigation. It may be looking like a silly mistake or super silly mistake, but you should not do it. Let us examine that one. Okay. Common mistakes while doing the tax audit. What are the things? Upload the correct CSV files. What is this? What is this one? See, In the utility, at various places, they give, okay. So at lot of places they give the facility of uploading the data in CSV, PFPSA details, addition to fixed assets, etc. Then when you are typing the data in that one, properly type it. Like X limited underscore PF underscore FY 1920, like that. Reason is very simple, because once you generate PF, that CSV file, etc., when they are uploading, I have seen, okay, for one client data they uploaded another one, because CSV file they say normally they keep in downloads or templates or temporary folders, they will upload. Okay, because in the last minute, you see December, it is already, we are doing so much of firefighting, every offices. So what happens is, on the last day, December 30th or 31st, he comes. He came already, but at that time we are filing 5 returns. So much of data is compiled. Everyone has given the XMLs on my laptop, and they're asking, RP sir, my different staff came, Andip came, Raghu came, okay, Acharya came, all these people came, and they are asking, sir, my data is ready. I asked one person, I kept their things, and I downloaded all CSV files. These people unfortunately assume that they have not done. They have not properly named the CSV file. When I'm uploading for one thing, other I uploaded, then gone. Of course, and you can tell immediately to the client to deny the tax audit report. Then again you can upload correct. But what happens if we already accepted? Then in such case, what happens is again you have to revise the 3CD. Then you have to upload the correct one. Remarks you have to say erroneous upload. But why is that problem? Because we have not maintained the name of the files correctly. I am repeating, it is a super silly mistake, but it happened for listed companies. That is the reason why I am explaining. At this juncture, I acknowledge the efforts made by Premnath sir, Vijay Srinivas sir. Last year they helped me, and this year particularly Mohan, who is working with Premnath sir, and Shravan, who helped in compiling this part, because I discussed with them in detail what are the mistakes, because I know some of the mistakes, because my clients got certain types of notices, and I checked with other chartered accountant firms also. I compiled. I am thankful to them. Always they are approachable, and I place on record their key inputs, including my staff Raghu, who always helps me at the right time. Okay, then approval to the 3CD by the client from his or its login. See, what happened is this point, yeah, again I missed the Bhishmacharya of GST, Mr. Satish Sharaf sir. So he told me this one, he observed that. Okay, one of the cases what happened is 3CD is uploaded. Then what is the next stage? The client has to approve. You may know that it is a simple thing, but one of the years they missed that point, because of which they slapped huge penalty, saying that your tax audit or everything is not filed at all, because it is in submitted mode. It is not finally uploaded. So not filed, 1,50,000 penalty of 0.5% of the turnover, whichever is high, something like that they have given. So immediately we pleaded. So say it is a erroneous and there is a reasonable cause for this one due to the last minute exception. Of course, it got dropped not at the lower level, it got dropped only at the commission level. So that is the reason. Ensure that the client also approves. Okay. If you have not noticed it, of course, CPC may give you a defective, but they have not taken any action in spite of that one. They felt that okay, it is not for us. Okay. Then likewise, CSV files, balance sheet and P&L account. This I only observed in one of the listed company. What they have done is, one of the very big listed company. Okay, the turnover is 40,000 crores, group turnover. So okay, you can imagine. On the desktop they kept a balance sheet, P&L, consolidated everything. At the time of uploading, what they have done is, instead of uploading the standalone, they uploaded the consolidated. So that's why name it properly. Ensure that it may be last minute job, but if you name properly, okay, so you won't do a mistake. Consolidated file means consolidated report. Standalone means standalone. Normally, see, many people they say that okay, XYZ Limited, XYZ Limited. What is XYZ Limited? XYZ underscore consolidated. It may be a super silly mistake, but I personally observed that it has been wrongly uploaded. Okay, so that is the reason why I am. Then ensure that correct UDIN numbers are quoted. They generated 5 UDIN numbers. See, 10 tax audit reports we filed, 10 UDIN numbers we quoted. So, for each respective thing, quote the appropriate, the relevant UDIN number only. Normally what happens? 10 number generated, this Control C, Control V. Instead of copying from one row, he skipped one row because of it, thing has gone for a toss. As of today, it is not visible in 3CD. The utility is getting changed. Means next year, going forward, they will change that this one. So it will be appearing in your 3CD also. Now, Mr. Satish Sharaf sir has informed me. So the GST portal and this portal have been mapped, the tax audit portal, everything. It is mapping back the UDIN numbers also. The GST department is mapping UDIN numbers. The income tax department is also mapping the UDIN numbers, which we quoted in either form 9C in GST or 3CD or 3CB, whatever here. So it has to be, you quote the correct UDIN number, as simple as that. The bottom line is that one. Right, beware of the latest amendments, this also. I told, see, immediately in the software company, 3.5 crores turnover. He started doing that, yes, tax audit is applicable. Then upon closer examination, we realized that the cash payments does not exceed 5%. Cash receipts does not exceed 5% of the total receipts. Then tax audit is not applicable up to 5 crores. So that benefit can be taken. So beware of the latest amendments. Then one more thing. When you opted for 115 BAB, like that 115 BAA, then what happens is BAB or BAA, in such case, when you are going for concessional rate of tax, examine the clauses, the section, how it is worded. For example, you opted for 22%, 115 BAA, BA. Then the clause says that in the case of general incomes normally fall under 30% bracket. Okay, so all those incomes are taxed at 22%, but they will be taxed on gross basis. What do you mean by gross basis? For example, this particular company are having one godown, okay, and they are getting rental income on that godown. That rental income is not used, so that they want to offer under income from house property. Normally, what you do? Income from house property, less municipal taxes paid, less standard deduction of 30%. Normally, that is the computation. But remember, when you are doing the 22%, the 30% standard deduction is also not allowed. You should know this point. If you want in detail, refer first to procedure to section 115 BAB. Otherwise, your computation goes for a toss. Then your boss or you yourself has quantified something wrong, and it goes. And once it is coming as an adjustment, they may levy penalty. If it is a 143 adjustment, the penalty is not there. But if it is a 143 adjustment, definitely that additional amount is liable for 270 a penalty. So to avoid that one, we should be knowing what are the amendments made in the relevant year. Okay. Then next one is ensure that various mandatory audit reports or forms are uploaded prior to filing of the report. I just told some time back, when you are uploading the, for example, 10 AA, when you are uploading the 3CD or 3CB or whatever of your client who is availing 10 AA, SEZ benefit, then before filing their return, ensure that before filing the return, you may not file, client may file, but before filing their respective returns, ensure that the proper report, like 56F, if it is SEZ benefit, 80IA is claiming 10 CCD, those are to be uploaded. For example, your client is getting what is this one, foreign tax credit, then form 67 is to be filed. Without form 67, they are denying the benefit. They are denying the foreign tax credit benefit. That is the reason you have to be careful here. Okay. Then, if you see the ITR, it is asking PAN or other number is in the case of bad debts exceeding 1 lakh. See, in the law it is not there. If it is in the opinion of the assessee, it is treated as a bad debt, then it is allowed as a deduction, subject to the fulfillment of 36(1)(7), assuming that that is fulfilled. And so 36 So even though that is fulfilled, even though 36(1)(7), 36 subsection 2, all those things have been fulfilled. But if the bad debt amount is exceeding 1 lakh rupees, either the PAN number or is an individual, if PAN is not there, Aadhaar is there, you have to quote that one. If it is, you are not quoting for companies, partnership firms, etc., generally PAN is there. Individuals, either PAN or Aadhaar you quote. You are not quoting that one, gone. So the 143(1) adjustment they are issuing saying that we believe that it is not a bad debt at all. You are writing it as a bad debt for the purpose of decreasing your profit. That's why we want to make adjustment. You can contest. You will definitely win in the appeal. But it resists in litigation. You get the data. So ask your client to get, okay sir, if it is more than 1 lakh, collect the details of PAN or PAN, etc. So that thing you have to be careful. Then keep the returns of earlier years also. Sir, why it is required? For the simple reason that last year there will not be any losses, but even prior to that year there are losses. So those losses are to be brought forward, carried forward to examine. So suppose by chance last year you forgot to carry forward, at least in the current year you disclose in the return. Okay, there are 2 years back I have a loss, so start claiming the losses. So to know the losses of the earlier years, you should keep ready yourself the returns of the earlier years also. Okay. Then last 15 minutes, it won't take more than that. Okay. So I will explain what are the points where you need to cross check with the ITRs. 15 minutes it will be over. After that, I will spend another 20 minutes or like that for the amendments relevant for the current year. Okay. Cross checking with the ITRs. Sir, when you are compiling the data for 3CD, you examine whether the data is corresponding to the respective place of the ITR also. What are the areas where you need to cross check? Okay. Nature of business to be aligned with ITR 6 part A general. See, tax audit we have seen class 10A, what it says, 3CD column, it says that whether there is a change in the business or not. 10B, 10A, what is nature of business? So whatever business you have selected in 3CD, the same should be there in the ITR also. You cannot disclose something there, you cannot, don't disclose here something. Okay. So because otherwise you will be landing up in huge trouble. Then 11A, books of accounts specified under 44AA, I elaborated this already. Only for 44AA cases only, that is specified professionals only, you put yes. In all other cases you put no. Then suitable disclosures are to be made with regard to ICDS. ICDS, if you feel that no, they are not at all applicable, or even though they are applicable, their impact on my P&L account, my computation is nil, even then, if there is anything to be disclosed, it has to be properly disclosed like under class 13F. Suitable reference to notes to accounts at least. So, because anyway notes to accounts you will be commenting on inventories, you will be commenting on construction contracts, revenue recognition, tangible fixed assets, government grants, borrowing cost, contingent liabilities, etc. So you have to give the cross reference of that particular serial number in the 3CD also. Otherwise, I told you there may be a chance that there is a penalty for the auditor under 271J. Yes, depreciation. So depreciation, whatever you are doing, ensure that it matches. See, broad numbers you should match. The details, the method of reporting, the columns which will be reported may be slightly different, the data which may be reported, but broadly the data, the numbers are to be matched. Mapped, yeah. Then PFPSI. So PFPSI part AOI of the ITR, that has to be mapped back to class 20. So that is to be ensured. You have to ensure that it is properly aligned. Like that. penalties, club memberships, etc. So ensure that the respective amount is sitting in the respective box of the ITR. Normally what they see in the last minute rush, they feel that okay, article students say that penalty, club membership, all expenditure, everything they will add in Excel, they will dump in the dumping yard at one place, gone. If you keep it like that, then what happens is, as a tax auditor, this person would have reported separately. But in ITR, he has reported in different column or he clubbed and reported. Then, because of that one, there is a impact. What is that one? The department issue a notice to you, 143, one year adjustment first they will issue, saying that there are 10 items which are there in 3CD. Corresponding adjustments are not there in ITR. That's why I'm making some additions. They will do that one. And already you disallowed everything, but through a different box. So it amounts to double disallowance. I am right now dealing one particular case, happened like that before the C8 appeals in Hyderabad. It is now transferred to National E-Assessment Center. So it may be allowed in the appeal, but why you want to take that much risk? So ensure that proper item goes and sits at the proper box. Club membership means it will be ensured that, because in ITR utility it gives so much of columns. Club membership, penalty for law, penalty for others, etc. Item wise it has given. So to the extent possible, wherever data is available, so fill up in separate columns. Don't club and don't throw everything in the dumping yard. Okay. Otherwise it will be subjected to double disallowances. Okay. Right. So I told you TDS disallowances also. TDS where it is deducted but not remitted, or not deducted at all. Then in such case, you are reporting separately in 3CD. Whatever you are reporting, ensure that 30% of that one or 100% of that one. In the case of resident payments, 30% is the disallowance. Non-residents 100%. That amount is getting quantified in the ITR. So here the total number, there 30%. You have to map, the base number should be mapping so that there are no inconsistencies. Yeah. Class 26, 43B payments. Ensure that it is correctly aligned with serial number 11. So what I told you, class A, B, C, D. How much is disallowed under 43B? Class A. It means how much is on account of statutory dues, PF, ESI. How much is on account of loans, deposits, interest on loans, advances taken from scheduled banks, NBFCs, qualified NBFCs, etc. So item wise you have to report separately. Don't report everything under 43B in single column. If there is a separate clause, you have to report it separately. After that, you have to align both. 3CD and ITR should be speaking about the same numbers. Then 269 SS STT, I told you, cross check with SFT also. That is the first thing. Then remember that 269 ST is very dangerous, I told you. Some people, they argue that, sir, I purchased agricultural land in a rural area and I given 20 lakhs in cash. The rural agricultural land is not a capital asset. That's why it is not covered. See, it may be exempt under capital gains, but it may be exempt under capital. There is no second thought about it. But there is a violation of 269 ST. If there is a violation of 269 ST, then the recipient, then there is a penalty of, so what is that one? 100% of the amount is liable. 100% of the amount is liable as a penalty. Okay. Each receipt in an amount exceeding 269 ST. So you have sold your agricultural land in a rural area and you receive, this has to be very careful when you are comparing this data compiling. Turnover should map with revenue disclosed in the manufacturing and trading account in ITR 6. See, in ITR 6 there is a manufacturing account. After that trading and manufacturing, then at the end result gross profit will come, then profit and loss account, etc. So whatever is reported in that trading and manufacturing, so that has to be taken into for computation of ratios. In P&L, other income will be reported. That won't be taken for the purpose of ratios. In simple terms, whatever is reported in manufacturing and trading account, the receipts, those receipts only count for the purpose of numerator or denominator, as the case may be, denominator, sorry, when you are calculating the turnover. So you have to be very careful when you are doing this one. The items appearing in manufacturing and trading account, that only you have to consider. Now let us understand some of the key amendments. Okay, so last 15 minutes, then after that we will be having a question and answer session. If any questions, I will next time. Okay, right. See, there are a lot of amendments, but I am explaining what is relevant for the purpose of comparing the data. Okay, are most prominent items, or which are applicable to majority of people. Monetary gifts received by non-residents from residents in India are deemed to accrue as in India. See, when a resident in India is giving a gift to a non-resident, it is deemed that it is always arising or accruing in India. If it is arising or accruing in India, what happens? It will become deemed income, accrued income. Deemed accrued, the moment it is a deemed accrued or Indian income, deemed Indian income, then in such case, it is taxable irrespective of the residential status of the assessee. He can be a non-resident, he can be ROR, he can be a RNR, whoever, whatever. So it will be taxable. It is treated as a deemed accrual. If the donor is a resident in India, then the gift is always deemed to accrue or arise in India. It covers only monetary gifts. But even though the clause says like that, the section says like that, but in the case of treaty countries, you can take the treaty benefit. Most of the treaties give the benefit relaxation, saying that because gift is treated as other income. Other income will be taxed only in the country in which the person is a resident. In this case, non-resident. In India is a non-resident, but in the USA or other country is a resident there. So the the rights to tax the other income is vested with the US government. Even the act says it is taxable, but through treaty you can claim exemption. But I am not talking about the treaty, etc. If there is any option to, the principle is, if any gift is given by resident in India, then it is deemed to accrue or arise in India. Okay, I am not talking about exemption portion. It may be exempted because of giving to relative. It may be exempted because of a treaty. But as a concept, as an amendment, it is introduced. Then the next one is 1034A. The 1034A benefit is extended to shareholders of all companies. What is 1034A? It is corresponding to 115QA. 115QA talks about tax on buyback. Earlier 115QA is applicable only for unlisted companies. Now 115QA is applicable for listed companies also, where the listed company is resorting to buyback or unlisted company is resorting to buyback. It has to pay the special tax under section 115QA. Since the company is paying special tax, it is exempt in the hands of the shareholders. So consequential amendment has been made under 1034A. The moot point here is 1034A benefit is available to unlisted shareholders of unlisted companies as well as shareholders of the listed companies. 40A. Then second proviso. Okay. The 40A benefit has been extended to non-residents also. So what is the benefit which is extended? There is a relaxation to residents. That relaxation is extended to non-residents also. For example, remember, this relaxation is available only where TDS is not deducted at all. Where you have not deducted TDS to a non-resident or a sum payable to a non-resident. Even though you have not deducted, but he has offered that in his computation, he has paid the necessary tax, he has filed the return under 139, and you obtained a chartered accountant certificate saying that all the conditions are satisfied. It means even though your client has not deducted TDS, but the recipient non-resident has considered in his return of income and has paid the necessary tax and has filed the necessary return, and the chartered accountant certificate has been obtained. If all these conditions are satisfied, then in such case, it will be allowed in the year in which return is filed. It means it will be first disallowed in the current year. It will be allowed as a deduction in the next year. So deduction is not lost. But there is a timing difference. This benefit is available only to residents earlier, but Finance Act 2019, Finance Act number 2 of 2019 brought an amendment. They extended it to residents also. They extended it to non-residents also. Sorry. The next one, okay, 43B. So 43B, the scope of 43B has been extended to strengthen the NBFCs. So earlier, interest on loans or advances taken from financial institutions, loans taken from borrowings or loans taken from scheduled banks, only that interest is covered under 43B. Now 43B is extended to interest on the loans taken from two types of NBFCs. What are the two types of NBFCs? First of all, your client has taken loan from an NBFC. That NBFC falls under these two categories. Then in such case, the interest is allowed under payment basis only. What are the two types of NBFCs which are covered under 43B? Number one, deposit taking NBFC. It means RBI permitted the NBFC to accept deposits from the general public. So that type of NBFC, from that type of NBFC you have taken a loan. Or it is a normal NBFC, it means it is not permitted. But its assets exceeded 500 crores. It means asset base of that particular NBFC is exceeding 500 crores. In these two cases, where you have taken a loan, your client has taken a loan from these two types of NBFCs, and the interest attributable to those particular deposits is covered under 43B. So it means it is allowed always on payment basis. Okay. Then 79, I told you. So 79 benefit has been given. They amended. I told you eligible startups. 79 provisions are little relaxed. So instead of 51% shareholding criteria, what they have done is, if all the shareholders continue for a period of 8 years, then 79 provisions are not applicable for 80 IAC. That is the amendment which they have given. Then 79, one more amendment is also made. See, where there is a change in the shareholding pattern, more than 51%, because of a government's order, because of a tribunal's order, then in such case also the provisions of 79 are not applicable. It means full losses can be carried forward even though there is a change in voting power by more than 51%. Right. 92 CE, secondary adjustment. Okay. The secondary adjustment, earlier there is a small mistake that has been rectified now. There is interpretational issue that has been rectified. And one more thing, what they have done is, okay, so they made it very clear that it is applicable only from the assessment year 1819 onwards, and it is applicable only if